This is the study session on ethical and professional standards. This is reading 4, Introduction to the Global Investment Performance Standards, better known as GIPS. Let's first define GIPS. It's a standardized set of ethical practices created and administered by the CFA Institute. The idea behind this is to provide investors with a means of analyzing historical data published by money managers to make an apples-to-apples comparison. Standards apply industry-wide and enable investors to evaluate the performance, the relative performance of fund managers. Now, why did the Institute create these GIPS? And to understand this, I want you to go back to the old days before there were things like computers and email. And there were managers out there who were running hedge funds and mutual funds and investing in stocks and bonds and alternative investments and stamp collections and all sorts of stuff. Imagine the hodgepodge of monthly or quarterly reports that were sent to investors all over the world. So like-for-like performance comparison was quite a challenge because even in today's high technology environment, it's tempting for firms to pick the best performing portfolio as a representative of the firm's overall investment results. It's tempting for firms to exclude portfolios with poor returns. This is called survivorship bias. It's also tempting for firms to handpick only those time periods that were marked by outperformance. And so the GIPS were created to provide a standardized set of acceptable performance standards. Who can claim compliance? Only investment management firms that actually manage assets. Plan sponsors, for example, a company that has a pension fund, the company itself cannot claim compliance. Consultants cannot, software developers and vendors cannot. It's really not the job of the CFA Institute to go out and evaluate and measure the algorithms written in all the software and the software packages. So only investment management firms that actually manage assets can claim compliance. And compliance has to be full compliance or non-compliance. Partial compliance is not an option. You can't say, oh, we comply with these portfolios over here, but not these portfolios here. Full compliance. Who benefits from compliance? This should be an obvious notion. Of course, clients and prospective clients and the investment management firms themselves. Think about this. Clients can now have a degree of confidence when comparing portfolio performance between and among managers. Compliance is also seen as proof that the firm upholds a high level of ethical behavior. And of course, the management firms enjoy the benefits because they have a greater level of credibility. Let's talk about this concept of composites. What are they? A composite is a group of discretionary portfolios managed according to a specific mandate or strategy. Of course, discretionary portfolios are those in which the manager has discretion over the buy and sell and hold decisions. GIPS compliant firms must include all fee-paying and discretionary portfolios. Subjective selection is not allowed. And of course, composite guidelines will prevent firms from using only their best performing portfolios. Here's an example of a composite by Latif Investment Management. This one goes from 2009 and year to date as of March 31st, 2018. And by the way, I encourage you to do a quick search online and come up with this exact page. This is actually truncated. The results for Latif go all the way back to the early 1990s. I encourage you to read the notes after this because there's some really interesting things about the notes. Let's take a minute and just quickly look at these composites. So note going down the left-hand column, those are the years. And then the next two columns are annualized net returns. And just a cursory glance going back from 2009 all the way to this current year, you'll see that the composites, they're generally somewhere around the S&P 500 index return, with the exception of 2014 and 2016. Those were clearly bad years for the composite. Then we have two columns of 3-year annualized standard deviations. And so this standard deviation is computed over a 3-year period. So you take the average of that 3-year period and then you deviate that high and low across a wide range of possibilities. Lots more to come about the computation of standard deviation in a future study session. Nevertheless, standard deviation measures some kind of variability. And so it's clear that this composite generally has higher standard deviations, which means it has higher risks than the S&P 500 index. Now, the annual composite dispersion is an internal composite dispersion measure, and this is calculated a little bit differently. It is a standard deviation, and the notes that follow this truncated table show that this is an asset-weighted standard deviation. And so this is calculated internally a little bit differently than the 3-year annualized standard deviation. And so just by definition, it's going to be smaller. But essentially, this measures the variability within a composite. There are the composite assets and the firm assets and total assets, and then wrap assets at the end, last column. And so this gives you kind of a sense that these are performance presentation standards that are GIPS compliant. You can see that right in the middle of the page. It's highlighted under the blue box. And so this investment management firm has done a great job of presenting this in their non-taxable multi-cap growth equity composite, non-taxable. So this is probably some kind of a retirement fund. Other points to consider about composites. Non-discretionary accounts must not be included. Of course, when the client is making all the trading decisions, it doesn't make sense to include that in a composite because it's not going to reflect the skill set of the manager. New accounts should be concluded in a timely and consistent manner. Terminated accounts must be included up until their last full measurement period. And accounts should not be switched from one composite to another unless the client's risk and return objectives have changed significantly and are documented. Remember our previous videos on the need for disclosure. How about this concept of verification? Verification refers to the process by which a firm claiming compliance hires a third party, an independent third party, to evaluate not only the processes under which the compliance is claimed, but to corroborate the firm's assertions. Verification simply means that a third party says, hey, yes, this is accurate. Verification is recommended, but not requirement. Two key issues for verification: whether or not the firm has complied with the all firm-wide composite construction requirements, and whether the firm's processes and procedures have been performed in a compliant manner. And there's an example of a statement of verification. In the next reading, there's going to be a discussion on the entire GIPS standards: fundamentals of compliance, input data, calculation methodology, composite construction, disclosure, presentation and reporting, real estate, private equity, and then some other kinds of accounts. This will be discussed in the subsequent reading. That's reading 4, Introduction to GIPS. And then reading 5 will be next, which is an actual in-depth discussion of the GIPS standards.